One man, no Federal Reserve, and a weekend that saved American finance from total ruin. In October 1907, the New York Stock Exchange didn't have a safety net. There was no Federal Reserve, no circuit breakers, no government bailout fund. When panic hit, there was only the market and the people in it. By the time that October ended, one private banker had personally intervened to stop a cascading collapse that threatened to wipe out savings across the entire nation. Exhibit 1, the trigger. On October 16th, a prominent New York banker named Frederick Augustus Heinz and his brother tried to corner the copper market. They failed spectacularly. Heinz Bank collapsed. The news spread fast. If one major bank could go under that quickly, what about the others? Exhibit 2, the cascade. Trust evaporated overnight. Depositors lined up outside banks demanding their money. Banks called in loans to raise cash. Businesses couldn't pay those loans back. Stock prices cratered. By late October, the panic had spread from New York to Philadelphia to Chicago, rippling outward like a financial earthquake with no epicenter. This is where the machinery breaks down. Without a central bank to inject liquidity, to pump money into the system when it freezes, there was no official lever to pull. No institution designed to be the lender of last resort. The banking system had to save itself or watch itself burn. Exhibit 3, the man J.P. Morgan was 70 years old, the most powerful private banker in America. On October 22nd, he called a meeting. In his library at 219 Madison Avenue, he gathered other bankers and financial leaders. That weekend, they hammered out a rescue plan. No government involvement, no official authority, just the decision of wealthy men to keep the system from imploding. Morgan and his coalition injected capital directly into the market. They guaranteed deposits at failing banks. They coordinated credit lines. The message was simple: we're standing behind this system. Within days, the panic stopped. People stopped withdrawing money. Loans got repaid. The spiral reversed. But here's what's crucial to understand. Morgan didn't save the system because he was altruistic. He saved it because the system's collapse would have destroyed his own wealth and power. Self-interest and public stability aligned this time. There was no guarantee they'd align next time. The Panic of 1907 killed roughly 80,000 jobs and wiped out millions in savings. Thousands of businesses failed. The damage was real, but it could have been far worse. Without Morgan's intervention, the entire financial system could have seized up. There would have been no credit, no loans, no way for businesses to operate. Exhibit 4, the lesson Congress learned. The Panic of 1907 exposed a brutal truth. Leaving finance entirely to private actors meant leaving stability to chance. In 1913, Congress created the Federal Reserve, a central bank, a permanent institution designed to do what Morgan had done as a weekend emergency: manage liquidity and prevent cascades. So that's why the Federal Reserve exists. It exists because one man's private decision to rescue the system revealed that private decisions aren't enough. Markets need infrastructure. They need backstops. They need institutions designed to prevent the kind of panic that 1907 showed was always waiting in the wings. The Panic of 1907 wasn't inevitable, and it wasn't inevitable that Morgan would step in. But once it happened, once the machinery failed and one person had to fill the gap, it became clear that gap shouldn't exist. That's how the world's most powerful financial system got its central bank. This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe to uncover the hidden machinery behind every financial crisis. There's a new one every week. This video is for educational and informational purposes only and is not financial advice. Always do your own research.